Welcome to TMS Insights. It's early April and we're bringing you an update just on the eve of Easter, which is obviously a great time for everybody, but it hasn't been a great time in the markets overall. Ben coming in from interstate today. It's harder to get together when we're so busy with everything going on. But Ben, it has been a busy period, and for a lot of people, there's been a lot to concern yourself with, and equity markets have shared some of those concerns.
Yeah, I mean, it's just been such a volatile few weeks. Clearly the Trump gave a timeline of sort of 4 to 6 weeks for this incursion into Iran. We're in the end of week 5 now, and probably he will have addressed the nation before this video has hit everyone's inboxes, but widely expected to announce victory and to lay a framework for a imminent ceasefire and a removal or leaving the country within a week or two. So, markets sort of felt to me, Jeremy, like, it's obviously a lot of volatility, but fairly relaxed. But with each day that this continued to push on for, the worries started to really grow. And because, the concern is that this creates a structural change in the energy markets, which effectively is a tax on consumers globally, and sets back economic growth. We've seen pressure in bond markets, of course, with bond yields very strong, which is not good for equities typically. But in the last couple of days, the markets have cheered the news of a potential ceasefire.
Yeah, that 10-year bond's back in the 4.9 sort of level here. We've seen oil prices come back. You mentioned Donald Trump claiming victory. We had the Prime Minister of Australia speak to the nation overnight. Look, there are issues that are going to be affecting consumer sentiment, which is 60% of the economy. So it's going to have some impact. You cannot ignore that. For how long is the big thing? If it can be ended soon and breeze through reasonably quickly, the impacts will be quite minimal, but that nobody knows how long these things are going to go on for. What we do know is price, and price is a guide to value, of course. And one of the things we can bring up on screen here is just that fear index, Ben, and just there's a good, very, very simple way of measuring sometimes the frothiness of markets or the absolute pessimism of markets. And money's made, of course, by buying when things are cheap and when things are pessimistic, and that fear index is at extreme fear.
It is, and this is always something that I guess we keep an eye on. There's a lot of great charts out there that get updated regularly, and we can see that markets are at max fear, or they certainly were 2 days ago. That probably a bit of a relief in the last couple of days, but we look at a couple of things we look at is the Bank of America Merrill Lynch Fund Manager Survey, which gets released every month. Fund managers are currently sitting on their highest cash weighting in some years. Conversely, that's actually a good sort of setup for going forward.
Yeah.
And the other thing that's got a lot of talk, I was watching CNBC down here this morning, was the level of short exposure over the big US market ETFs, which has apparently hit 12% a couple of days ago, which is the highest net short positioning we've had in the US market since the peak of the COVID issues back in 2021. So, sort of max short, lots of cash on the sidelines, and the other thing I'd say is like valuations on individual stocks, which we've been, talking to the clients we've been doing reviews with recently. You're now paying a sub 20 PE for stocks like Amazon, Microsoft, multiples that we actually haven't seen in many cases these companies trade on before. So valuations are reflecting the concern that's out there, and there hasn't been an earnings issues to warrant the valuations. It's more investor mood.
Yeah. And obviously, we said it on previous videos that geopolitical events come and go.
Yeah.
The things that will worry us are not those so much. It's liquidity issues. And we've seen corporate bond spreads and really quite tight, and the flow of money remains very solid. So there's no liquidity concerns right here in terms of the funding markets, and that's really important. And as you mentioned, we're on the back of very good earnings out of both the US and the Australian market overall. So that's the basis on which we think about investing, and again want to plan our thinking. The nature of wars and catastrophes and the like do come and go, and there've been a myriad of them over the years, and we can certainly demonstrate that very easily graphically to show how little impact they have when you take the perspective of time. But in the moment, they're really quite material, and we always can get caught up in it. But investors that make money do not. They actually go the other way. Talking about that, look, one of the good things to do in markets like this is go back to first principles and look at best investors. We had a report here, not a lot of reports in our company. Sol Pattinson report really have morphed into terrific, diversified. This last year's been pretty instructive to a new future for them. $470 million of cash they've got built up. Berkshire's at record levels of cash. Just some insights and takeaways from two incredible investment companies, one here, one in the US.
Yes, it's like the Sol Pat. You look at the one of the reasons you want to have maybe these sort of stocks and good weightings to them in your portfolio is the shock absorber that they give maybe the more growth orientated investments that you need to have in a portfolio as well. And I think Sol Pats has nearly hit $41 now. It's actually been rising share price wise during this period of volatility and pain in some other parts of the market, and as has Berkshire. And these businesses are seen as a safe place to be during troubled times, and it's because of those big cash weightings, the lack of any debt on the balance sheet, the ability to take advantage of periods like this. This is when these sort of companies will be deploying money, not selling down, and that reduces overall portfolio volatility. But also, both of these companies, on top of that, have created a lot of wealth over many years for their shareholders, and in Sol Pat's case, paid a great dividend. So, I think that the takeout from Sol for me, Jez, was it is a leopard that is rapidly changing its spots, and the private equity and private credit parts of the business are becoming much more significant in size and generating returns well above long-term share market averages. And and Rob, when we last caught up with him and had a briefing with clients, he sort of said that is the direction this company will continue to move in, particularly on the private equity side. So I saw Warren get also yesterday watching CNBC. Saw Warren get interviewed, and he made some pretty interesting comments. One of which I thought was sort of lamenting the fact that he sold out of Apple too early, and saying that he would love to buy back into that company if he felt he could get it at a good price. But also sort of saying, he spoke about the recent investment that they've made in Google, and they've become one of the largest shareholders in Google quite rapidly now. So they're still finding value out there, but they're sitting on a lot of cash.
And it's interesting, you and I were there in Omaha when Charlie Munger, the late Charlie Munger, mentioned we can't believe why we never owned this stock. We're talking about Google now, Alphabet, because they saw how important it was to their insurance business.
Yeah, completely.
How it actually drove a lot of the traffic to them. So it's a stock they didn't own in 2018. They only bought in 2019. And again, Apple, we remember seeing Tim Cook there in the front row. So, and they had a big anniversary this week, Apple. So 50 years onwards, upwards. So then
just the other thing I would say, Jez, just while I'm thinking of it, that Warren also spoke about, and using his words, not mine, is just the strength of earnings growth that is predicted for the US market going ahead. So like consensus estimates for the S&P 500 are currently around 15.5% earnings growth for the forward year. Now, over the last 50 years, the average earnings growth's been about 9%. And if you strip out the year coming out of the GFC and the year coming out of COVID, which were both sort of one-off weird sort of things, you got to go back to the late 1990s / early 2000s to find a year where the market had such strong earnings growth. So, potentially that earnings growth, I suspect, might be a bit lower than consensus because of the issues with Iran, and there is going to be a bit of a flow on that might, maybe it ends up at 13 or 14% earnings growth. But it's still going to be much stronger than we have seen in recent times. And the other point Warren was making was it's much more broad-based. It's not a very small group of stocks doing the heavy lifting for the overall market. It's that this trickle-down impact is. So, his take was the US economy is still in really good shape. They're still looking at potentially, if this Iran thing moves on fairly rapidly, they're still potentially in a rate cutting cycle. Valuations look appealing, and the earnings growth outlook is stronger than historical averages. So there's still a lot of reasons, if we can put this war to, hopefully we can move on from it. The outlook is still pretty good.
And the thing for an Australian investor, Ben, is to clarify how much value is created by the strong performance of the Aussie dollar through the back end of the year and the start of this year. So when we're looking at US dollar assets, as you mentioned earlier, PE is basically in some big companies, some great companies, half their 10-year long-term average, and with a handle almost 70 cents. It's pretty affordable from an Aussie investor adding to those US holdings that we like.
Yeah, I think so. And obviously a lot of questions from clients about, what should we be doing or what should we be looking at? And I find it hard to go past, I think, the backdrop of the US market versus the ASX, not to say anti-ASX or anything, but I just think, to me, the economy there seems to be in stronger shape than ours, and the ability of businesses to grow their earnings, even very large businesses, seems to be better. And as you said, we've got a better buying power now with Australian dollars than we have for a while. So, like even another thing I saw this morning was, you look at Visa and MasterCard, are now trading on some of the lowest PEs they've been on in 3 or 4 years, because there's this concern around US consumer sentiment, et cetera, et cetera. But you don't get the chance to buy these sort of businesses on low multiples very often. And there's always a reason why they're trading on low multiples. And you can always think, well, I'll just wait off and, sit this out. But as you've seen in the last 2 nights, the Nasdaq's put on 5% in 2 days. It can turn around pretty quick.
It can bounce fast, and great companies don't go on special very often.
No,
that's the reality.
That's
right. But that's really, we might wind up now, Ben. Wishing everybody a great Easter, and we'll be back with another TMS Insights later in April.
Happy Passover, Jez.
All the best.